Okay, so we are recording on Zoom, and if you're ready, I'll start on the other one.
You bet.
I may say something at the beginning of the show. I've still got this bug I'm trying to overcome, so we'll see if I can keep that under control as well.
All right.
So, okay, you ready? On this week's episode of the podcast, Giving Your Way Out of Debt with Paul Moore. So welcome back to this week's episode of the Crushing Debt podcast. My name is Sean Yesner with Yesner Law. And as I've been saying for a while, this podcast is brought to you by my law firm, Yesner Law. And also, I would really love for you to check out the book that I wrote. It is on Amazon. It is called Crushing Debt, 9 Strategies to Eliminate the Financial Bullies in Your Life. I would love for you to go on to Amazon.com, check out the book. If you like it, leave a review. If you don't like it, you can still leave a review, but I would much rather prefer people that like it to leave a review. But I don't want to spend too much time talking about me. I want to focus here on my guest. So my guest is a repeat guest. If you want to hear our first conversation, go back to episode 78, where we talked about reducing tax liability using multifamily housing. My guest is an author. His book is called The Perfect Investment. You can find that on his website. You can also find that on Amazon.com. And so welcome back, my guest, Paul Moore. How you doing, Paul?
Hey, Sean, great to be here. Thanks for having me on again.
Yeah, so The Perfect Investment, you sent it to me. Episode 78 was back in, I think, September-ish of 2017. And I got a copy of the book right after. I appreciate it. I read it. I love the book. The book is tremendous. It's got all kinds of different strategies, all of the stuff that we talked about, the reducing the tax liability, why multifamily is a good investment, how to get involved in multifamily. I really love the book. And so I do want to let people know they can find that on your website, which is www.wellingscapital.com, WELLINGS capital, CAPITAL.com. They can also contact you, Paul, at wellingscapital.com. If they want to pick up a copy of The Perfect Investment. So a great book. I do suggest anyone interested in multifamily housing has to get a copy of your book, The Perfect Investment. But welcome back. I appreciate you being back on the show.
Yeah, thanks, Sean. I appreciate it. And I'm hard to believe that you would have somebody on here who has a podcast called How to Lose Money. But hey, thanks for having me back anyway.
Yeah, that's right. I was on your show as well. And I think we're trying to coordinate a date for a repeat appearance. So I got to figure out how I've lost money a second time.
Oh, man, I hope not.
But we'll get that figured out. But I know we wanted to talk about 2 different things today. So I want to talk to you. Why don't we start first with the things you've got going on for real estate investors, to support, everything you're doing with multifamily housing and commercial real estate investing. So what do you have going on that front?
I wrote a book that was not at all arrogantly titled The Perfect Investment. And then I came to the conclusion that, a lot of other people saw it that way too. I mean, the demographics, the low default rate, all the amazing things about multifamily housing were attractive not only to us, but to institutional investors, to international investors, 1031 exchange money, all kinds of people were throwing money at multifamily. And frankly, it's gotten overheated. And so I realized that, we have a lot more investors that trust us than we do deals. And so I said, we got to look outside of multifamily. So a little over a year ago, I started looking at self-storage, mobile home parks, and evaluated these asset classes. And Sean, I was surprised at how fragmented these markets are, meaning that there are a lot of mom and pop owners. For example, self-storage has about the same number of facilities nationwide as the Starbucks, McDonald's, and Subways combined. And about 75% are owned by mom and pop operators or small independent operators that don't know how or don't even care to maximize the value. And there are about the same number of mobile home parks in the U.S. And a lot of those, as you can imagine, are owned by mom and pop operators. But there's a lot of reason to love these asset classes. The tenants are really sticky. That doesn't mean they wear Velcro suits. That means they actually, they stay. I mean, if you were renting a $300 a month mobile home park site and I raised your rent by 10% to $330, you're probably not going to have $5,000 at your disposal to move down the street to save $30 a month. Same with self-storage. If I'm renting an apartment at $1,000 a month and raise the rent by 6%, you might move to save $60 a month. But if it's a self-storage unit at $100 a month, you're probably not going to move for a 6% raise at $6 a month. So there's a lot of reasons. Both asset classes are recession resistant. And so we've pulled together, we realized we love these asset classes, but we didn't have experience in them. So we pulled together two funds to allow investors to pool together money to invest and get these great returns, the stability, the predictability, and up and down economic cycles, and the tax benefits we talked about before. So that's what we're up to these days.
It's really interesting. So two comments that I was thinking of. First is with mobile home parks specifically, they're not really mobile homes. They are, they can be disassembled, they can be moved, but it's a process. And so like you said, people don't have the money to pick up and move down the road and move their whole entire house to the next park. That takes quite a little bit of a financial investment. And I know specifically in Florida, there is a mobile home park statute. So there is a specific Florida statute that deals with mobile home parks and when you can evict somebody, and do they own the mobile home, or do they rent the land, or do they own the land and have the mobile home on it? So there's all those different kinds of details, but that is an interesting investment. There are a handful of investors down here that I know of in Florida, in my area, that do invest in mobile home parks, and they do quite well in that little niche. So I like that.
Mm-hmm. Yeah, it's surprising how recession resistant it is, Sean. And it's the only asset class I know of that has an increasing demand but a shrinking supply. There's a lower number of mobile home spots every year than there were last year. In fact, I saw a study of Central Florida that showed I think it was a 5,000 lot decrease over a certain number of years. And so it's a real problem for affordable housing, and it's not going to get any better because there are no cities that I know of who are excited to have a new mobile home park,
Yeah. So are these funds focused on mobile home parks all over the country, or are you focusing on an area in particular like Florida?
When we were syndicating multifamily, we were focused on certain states like the Carolinas. But now, as a fund manager, we are kind of like Buffett. We are focused on finding great operators with a great track record, great character and ethics, and they may be anywhere. So we're talking to one, for example, in the Pacific Northwest right now. We're talking to another one based in Florida. And wherever they know real well, we're going to trust that they're investing in the perfect location for their expertise.
Okay, so the way that it would work is if I were interested, for example, and right now I'm interested in growing the law firm and I'm interested in growing the podcast, but let's assume that I was interested in investing in mobile home parks and I found one that I thought was a good deal. I would then contact you and your fund would provide the financing for me to purchase the mobile home park. Is that right?
That's close. If you were, since you're focused on the law firm and the podcast, we wouldn't actually partner with you as an operator. However, if you were a deal finder, Sean, and you were able to bring that deal and we were able to link you up with a fantastic operator who had decades of experience and a team, we brought the money, you brought the deal, they brought the operations. Yeah, that's exactly what we'd like to do.
Okay. Well, and I just wanted to make clear that, I do invest in stuff, but right now mobile home parks are not. I've got other things on my mind. So
sure.
But if I were to do it, absolutely, I would give you a buzz. I want to turn my attention real quick to the self-storage unit. I thought it was funny. I was talking to somebody, and I forget if it was a financial advisor or an economist or something. And I was talking to somebody, and one of the funny things that they mentioned is only in our society could you have, and right now we're in this trend of downsizing and getting rid of assets and getting rid of things and things you don't need. And we're in this age of what's the show on HGTV about the people that just accumulate all this stuff and hoarders, right? Self-storage units are an anomaly in that it's the whole purpose of the self-storage facility is to store stuff that we don't want or don't need at this point in time.
Yeah.
So it makes it a little bit of an economic quirk, especially that you're saying, I agree with you that it's recession proof, but it makes it a little bit of a quirk in this age of, especially with what I'm doing and trying to help people get rid of debt. One of the best ways to help get rid of debt is to get rid of the stuff you don't need, which may ironically include the storage unit.
Yeah, it's absolutely true. But during the recession, Sean, people were downsizing from their 4,000 square foot home to their 2,000 square foot home, or from a 2,000 to an apartment. And when they did that, they needed a place to store their stuff. And of course, baby boomers' parents have been passing away, obviously. And that we need a place to store their stuff. And sometimes we're in a transition between homes or moving or building a home. We need a place to store stuff. In great economic times, we're filling up our Amazon and Walmart carts and we need a place to store our stuff, right?
Right.
So it really is surprisingly good in all kinds of economic cycles. The risk, of course, is that it gets overbuilt, and like everything else, that could happen, and it is happening in certain markets. And so we got to be very, very careful where we invest.
Oh yeah, it is. I notice storage units, storage facilities going up all over the area here where I live in West Chase and Tampa. I notice self-storage units going up all over the place. And it is interesting. I made the comment, but at the same time, I've used a self-storage unit before myself. I used one when I was down in Miami. I had just graduated law school and I had moved back in with my parents to get back on my feet after getting that first job down in Miami. But I had all my furniture. And so I put it in a self-storage. There was no room for my furniture at my parents' house. So I put it in self-storage. And then when I moved up to Clearwater, pulled it out of self-storage. But then when I got married and combined my furniture with my wife's furniture, again, we were in a situation where the apartment we were living in and even the house we moved into wasn't big enough to fit all of our stuff. So we had to put all of that in storage. And then slowly, I think we downsized as we got the house we're in now and got newer stuff and were able to afford, newer stuff. We eventually downsized, but I don't mean to knock it intentionally. I've used them before. So I agree with you. Is that, you said you had two private equity funds. So is one of them specifically focused on self-storage and the other specifically focused on mobile home parks, or is it just whoever brings the best deal for the situation? Or
Mm-hmm. So we were in a quandary when we were thinking about this. We had one fund planned, Sean, and the fund was going to have, in a combination of income and appreciation. But we had investors with two very different needs. Some of our investors said, I don't want any income, just let it grow as fast and as much as possible. And another group said, I definitely need ongoing income. 7-8% would be nice. And then the appreciation would be the cherry on the sundae. So we realized with these two different groups, we needed two different types of assets. So in our income fund, we have mobile home parks, which are very steady, income producers. Then self-storage, which has income and a lot of growth. And then potentially we have multifamily, assuming we can find a good deal, which we haven't for a while. And then in the growth fund, we just have self-storage and theoretically multifamily. So that's how it breaks down.
Okay. Well, I want to turn, I titled the episode "Giving Your Way Out of Debt," which is something that you discussed during the pre-interview. But before we get there, anything else that you want to mention about the private equity funds that you've got going on?
Yeah, I wrote this book, The Perfect Investment, 2.5 years ago. And when I wrote chapter 8, I talked about the value equation for commercial real estate. And Sean, I don't think, as I read back through that chapter, I don't think I even understood the power of this. So think about it. If you are like Chip and Joanna Gaines Jr. and you are really good at locating houses to fix and flip or to rent, you might be able to fix up a house, let's say there in Bradenton, where, let's say everything else in the neighborhood's going for 350, but you just really max out your house and it's worth in your mind 650 because you put 300,000 extra into it. Well, you're probably not going to get 650 because, as we all know in residential real estate, the value is limited by the comps, by the comparable properties on the block or in the neighborhood. Commercial real estate's entirely different. The value formula in commercial real estate is the value is the net operating income divided by the cap rate or the capitalization rate, which is the ongoing rate of return that investors expect for that type of asset in that market. Now, if you can increase the numerator, increase the net income, and if you can find a way to compress the denominator, in other words, the cap rate, if you can get it down from, let's say, 7% to, say, 5.5% by selling to a REIT or another institutional investor, you can dramatically increase the value of the asset, but even more dramatically increase the value of the equity through leverage, safe leverage. And so if you want, I can give you a quick example of that.
Yeah, sure. Absolutely.
So this is theoretical, even though it's based on a real example we recently invested in. Let's say there's a mobile home park that went for $5 million, and let's say we invested in that. We would be investing $2 million in cash or equity and taking a safe debt level of about 60% loan to value, which would be $3 million in debt. So we've got $2 million in cash, $3 million debt, $5 million total. Now, this operator is really good at this. He went around and he said, hey, for you out here we want to clean this mobile home park up. So if you've got a third or fourth or fifth or sixth car or mobile home or extra little shed or, crummy, things sitting on the property like a boat or an RV or whatever, you're going to have to put this in this new fenced in area. So he paved an acre of weeds, put a beautiful fence around it, lock gate, and he said, you have to put your extra cars, etc., in here. And by the way, we're going to charge you for that. And then after he gets all the park cleaned up, he's going out now to the community and saying, hey, we've got boat and RV storage. Now, Sean, it cost him $100,000 to do this, but he's going to be able to rent this extra outdoor storage for $10,000 a month. That's about $120,000 a year. So he got a nice 120% annual ROI, which is good.
Right. Which is just that doesn't count the rents and the lot rents. That's just this one little lot.
That's right. That's right. You've got it. So that's really good for the income, but it's better than that because remember our value formula, net income divided by cap rate. So he just increased the net income by $120,000. If you divide that by an average cap rate of 6%, you take $120,000 by 0.06, he just increased the value of the asset by $2 million by this one change. Okay. And that's really good. So it takes the value of the asset from theoretically, of course, 5 million to about 7 million, which is about a 40% increase. But it's better than that because the equity investors only have 2 million cash in this. Get it? Right. They just doubled their stake from 2 million in equity to 4 million in equity. And like you said, that's just by one change. Now it's going to take a couple years to pull this off, but one change, double the equity. He just had 100% appreciation on the equity. And that is the power of forcing appreciation. And that's just one example of dozens we could talk about, Sean.
Yeah, I was going to say, I think you said you made the example in your book. I don't recall, but I was going to say it seems like a little bit better of an improvement than installing vending machines and laundry machines.
That's all good, though. That all adds to it. If you can think about this, if you can, let's just look at $1. If you can increase the revenue at a commercial asset by $1, that's $1 a month is $12 a year. $12 divided by 6% cap rate. That's $200 increase in asset value, 2.5x if you're using 60% leverage. And so that's a huge increase from just $1. So anywhere we can pick up $1, whether it's through increasing the lot rent by $10 a month, times 12 months, times the number of lots, or installing a billboard or cell tower or vending machine, it can be really, really powerful, Sean. And this is why I love commercial real estate investing.
It's interesting. I had a potential client come to me, and I don't think I could help them, but they came to me because they were in a situation that you described as the owner in the park, as one of the lot owners, as one of the mobile homeowners in the park. They had received a letter from the manager that said, hey, we've created this new space that, you need to take your trailer, is what they had, and put it in this space, and the rent for the trailer is going to be X. Now, the problem that this park owner did, or park manager did, is he didn't make it nice. He didn't pave it. Like you said, he fenced it in, but the lock didn't work. And so there were some issues there from a legal perspective. And I'd wondered, in my thought, my legal brain, it was because they didn't want this work trailer to be outside the mobile home, outside of the home on the lot. But now that you describe why they might want to do it that way, it makes a little bit more sense as to why they were having all the trailers and all the boats and all the whatnot moved. I think the park owner needs to do a little bit better job of creating the space to store all these things. But that's interesting. So I learned something new on my own podcast. That's always a good thing.
Awesome. That's great, Sean.
So I do want to turn my attention, though, to the title of the episode, which is Giving Your Way Out of Debt. And so, one of the things that I'm doing with my show is I want to start to talk to people about stories about how did you get into debt? How did you get out of debt? And so as listeners, we can learn from each other some tips, some strategies, some techniques to actually get out of debt. And I know you and I were talking about this in the pre-interview, but I think it's probably best just to turn it over to you and let you describe what we were talking about.
Okay. Well, I was in my mid-30s, and we had a company that became the industry we were in, which was PEO, Professional Employer Organization, became the darling of Wall Street in the 90s, like mid-90s, like 1997 specifically. And a company we knew had gone public, and they wanted to get a Michigan office. So they bought our office for like almost, I think it was $2.9 million. I was able to put about 1.7 of that in the bank in 1997. Now I was in my mid-30s, and I had no idea the difference between speculating and investing. Sean, when investing is when your principal is generally safe and you've got a chance to make a return on it. And speculating is when your principal is not at all safe and you've got a chance to make a return on it. So I made some really bad investments, or speculations, I should say. And I made some good ones as well over the next 10 years. One of the things I invested in was a lot of waterfront property at Smith Mountain Lake in Virginia. I had all kinds of waterfront lots. We made hundreds of thousands of dollars flipping those in the early 2000s. But 2007 came along. We found ourselves $2.5 million in debt. It was all attached to real estate of some type, including our vacation home at that same lake.
Wait, I'm sorry to interrupt. Before you get to the $2.5 million in debt, how much did you have in the bank when? At the beginning of the story, when you said that you had got bought out, how much did you have in the bank around that time?
Around 1.7 million.
So 1.7 million, and now we've flipped the story to $2.5 million in debt.
Right, and we had all kinds of assets. I mean, every single bit of it. There was no credit card debt that I recall. Maybe some home equity line, I guess, but. It was all tied to real estate. One of the things I love about real estate is that it's a real asset. It's not like, investing in a penny stock that can go to zero. I mean, real estate usually doesn't go to zero value, except some people in Florida might have wondered back in 2008.
Right.
But at any rate, I found myself in the fall of 2007 when my partner announced to me, I can't do this anymore. I can't pay half of the interest on a lot of this $2.5 million. And so come January 1st, I'm done. And I said, well, but we're going to have a breakthrough. And we're going to, of course, I didn't know how bad the recession was going to be. We just thought it was a dip in the road at the time. But that's not the case. And so around December of 2007, a couple of friends of mine had me out to eat at a restaurant and said, Paul, face the facts. you're not going to get out of this. You need to declare bankruptcy. I said, you got to be kidding. I said, we've got a plan to get out. They said, what's that? I said, we're going to give our way out of debt. And that went over just about like that. We're going to give our way out of debt. I said, and they said, you care to elaborate? And I said, I really believe in the universal law of giving and receiving, of sowing and reaping. Some people call it karma. And I really believe if we begin to give aggressively to nonprofits, charities, churches we care about, that we're going to see a return on that. And I really believe that you'll see what I mean. Just give me a few months and I'll show you. And so I went home and announced the same thing to my family. I've got 4 young kids. And one of my goals in life, Sean, is to always leave a legacy for them and to do some wild and crazy things that they will be able to tell their grandkids about. And so this was one of those. So I told them. My wife was really puzzled because she, unlike the kids, understood what I was talking about. And she's like, what? But she came on board. We didn't have any other options really. So starting January 1st, we started writing a fairly significant, large check every single week to these nonprofits, charities we cared about. And we just waited to see what would happen. Of course, I'm working the whole time as well. My partner dropped out. I was left with the entire interest on that debt. And about the 4th week in January 2008, Sean, I was at a Subway restaurant and I ran into a developer I knew, a real estate developer, and I was lamenting our situation. He was lamenting his. And I said, well, I got this 5-acre parcel at Smith Mountain Lake. I would love to subdivide it into 5 1-acre lots, and it would be worth a lot of money. That's a huge part of my debt right there. He said, well, you ought to use the family exemption. And I said, well, yeah, I'm aware of that. And see, Sean, the land is on a private road or private lane. It wasn't on a publicly paved road. We were banking on the fact that it would be eventually a public paved road really soon. That's that speculation I was talking about. We heard rumors it was going to be a public road in a short time. Well, it wasn't, of course. And he said, you ought to use the family exemption. I said, no, that won't work. I said, I know about the family exemption. Here's how it works. And I explained it back to him. And he goes, yep, you're right. He goes, Matt, I still think there's something there. Think about it. And right when he said that, I had this moment. And I realized, wait a minute. It's like this light bulb went on. And I said, wait a minute. What if we flipped the family exemption on its head? And went in, and without getting into more detail, I called my surveyor. And he goes, that's the craziest idea I've ever heard. But why don't we run it by the county planning and zoning people? We have to run it by them eventually anyway. Why don't we just sit down and show it to them on, pencil drawing? And so the next day we went in, we met with the county planning and zoning lady. She'd been there for about 50 years, probably, maybe 30 at least. And she looked up over her glasses when I was done explaining this with this little smirk on her face. And she shook her head and she said, I've been working here for 30 years, and nobody has ever come up with such an outlandish proposal well, you're right. You found a loophole in the law, and I don't know how nobody else has ever seen it, but you found a loophole, and yes, you're right. You could do that. And so we spent a lot of time, a lot of money. We ended up in a legal wrangling with our bank who didn't want to let us subdivide the land. We ended up in all these other situations during that year. But the timing was crazy, Sean. Of course, we couldn't have known this. We were finally ready to sell these 5 lots, and we had 4 buyers lined up for 4 of them. And it was September 2008. And you all might remember that was right when everything went down. Lehman Brothers and Bear Stearns, everything else was happening right about that time. And we were trying to sell expensive waterfront lots. Well, guess what? We did. And we found ourselves 13 months later, completely debt-free.
Wow. That's awesome. And one of the questions I think you answered, though, I was going to ask, you were giving cash gifts, or were you giving other thing, donations to donations of clothing, donations of food, or was it all strictly cash gifts?
Well, we might have been giving stuff away like clothing to Goodwill or something. That was inconsequential compared to the cash gifts. Yeah, we were definitely giving significant, checks and cash gifts. I mean, honestly, I hate to admit it to your audience of all people, Sean, but we were probably borrowing some of that money just to give. But we
Wow.
had a set amount we were giving every week, and we were determined, and we did that all year, and we continued to do that actually for pretty much ever since then.
Yeah, and that's what we do. I call it, filling the karma bank. And so
Yeah.
I've given as well. I've taken on about one pro bono case a year. And so that is not an invitation for the listeners to call me and ask me to represent them for free.
What's your number?
Yeah, no, we do it through, there's a legal aid organization here in the Tampa Bay area that sends us about one a year pro bono cases. I've actually got a pro bono foreclosure case going on right now with a lady. So we continue to do that stuff as well, because I think it is important to give back. I think it is important to fill the karma bank. I think your story is tremendous, to get out of $2.5 million in debt. I recall one of my landlords in the early iteration of the law firm would throw pennies into the parking lot. And I said, "Why are you throwing pennies?" And he said, "I'm seeding the parking lot. I want people to come and park here and do business with it." He was a real estate investor as well. And, sure enough, that was also in that same 2008, 2009 timeframe. And the parking lot would be filled with people who were in foreclosure trouble. And so they were investment opportunities for him as the real estate investor, and clients for me as the real estate attorney. So,
wow.
A tremendous story. I love it. Thank you for sharing that. It's not easy to admit how far in debt some people can become, but I appreciate you sharing that story. So I think that's pretty much all the time. I think I appreciate you being on the show a second time. Not too many of my guests come back for a second time, not necessarily because they didn't enjoy being on the show, but because I want to make sure I'm still providing good content to the listeners. So thank you for coming on a second time. Anything we missed? Anything that you want to say real quick before we wrap up?
I don't think so. I think, going back to that investing versus speculating thing, I would say this, Sean, and I think your people, your listeners in particular would understand this, but Paul Samuelson was the first Nobel Prize winner in economics from the US. And Paul spoke about investing versus speculating. He said, investing should be like watching paint dry or watching grass grow. If you want excitement, take $800 and go to Las Vegas. I think the point there is, if you're an entrepreneur, if you're a business owner, if you're the type of person that maybe even chased shiny objects a few times over the years, don't confuse your investing with your entrepreneurship. Have all the fun, take all the risks, do all that stuff as an entrepreneur. But when it comes to your investing, I would recommend that people be very, very conservative, because if your investments are boring, chances are you might be investing in something that's going to make you wealthy and generate a significant amount of passive wealth during the rest of your lifetime. And that's the type of investments we're trying to do at Wellings Capital.
And I think that's tremendous advice. So again, if you want to get a hold of Paul, it is paul@wellingscapital.com, or you can go to the website, wellingscapital.com. While you're at the website, go and check out Paul's book, The Perfect Investment. I know there's a link from the website to the book, or I'm sure you can go on to amazon.com and check out The Perfect Investment or Paul Moore. I'm sure both of those links will also get you to the book. Thank you for being a repeat guest. If you want to check out Paul's previous episode, that was episode 78 of the Crushing Debt podcast. And I think with all of that, I think we can pretty much put a bow on this week's episode. So thank you again for being a repeat guest.
Oh, Sean, it's great. It was a great honor to be here. And thank you so much.
Yep. And we will catch up with everyone in next week's episode of the Crushing Debt podcast. And we're done there. And let me get Zoom stopped.